What's up, gold miners? In today's episode, I sit down with Axel Ragnarsson, a 29-year-old real estate entrepreneur who is absolutely crushing the game. We start the episode by going over Axel's journey on how he acquired and scaled his real estate portfolio to over 500 doors in his 20s. We also go deep into the tactics that Axel uses to find off-market opportunities. And then finally, Axel goes deep into the idea, the concept of picking a singular strategy, having a narrow focus, and why that has allowed him to do so much in so little time. This dude is the real deal, super impressive stuff, and I cannot wait for you to slap on those AirPods, turn the volume up, because this one is a banger. So without further ado, everyone, let's welcome to the show, Axel Ragnarsson. Axel, welcome to the Gold Mine.
Appreciate you having me.
You know, of course, man, you know, we just connected yesterday, so this is great, you know, love it, man. Johnny on the spot, you're like, hey dude, like, let's just do it tomorrow. And I said, let's do it. So love that you are, love the hustle, man. And it seems like hustle is kind of been like that predominant theme in your young life. You know, you got started in real estate at a fairly young age, which is great because, you know, we get all types of guests on this podcast. And so there's a younger audience out there for sure that listens. And so for someone that's just getting started, kind of talk us through that come up, like from early beginnings to now. Walk us through that journey.
Yep. Yeah, I'll try to give you the spark notes here and hit the important stuff. But yeah, I mean, you just touched on it. So I started buying real estate in college. You know, I've been in this for a long time now. That was 8 years ago. 2016 was when I did my first deal. And you know, even to go back farther than that, like I've always been the hustler, the entrepreneurial guy. I was the guy selling baseball cards at recess, you know, and my whole life doing anything I could to avoid having to work a job, right?
Yes.
So high school, early college, I was buying and selling cars. Like that was kind of my side hustle / business at the time. And was doing well, was making a couple of bucks, you know, relative to that age, I guess. And I realized though that after college, like that was never going to be the long-term thing for me. So I became interested in real estate through maybe got an Instagram ad. I don't even really remember, like, you know, HGTV one day and I was watching a house flipping show or something like that. But I was like, oh, flipping houses, buying real estate, that seems really cool. So I went and got my license and I went down the road of maybe I'll broker, but I want to go out there and I want to go invest in real estate. I want to go flip houses. Like that was how I got into the business. As I was looking for deals, I stumbled upon rental real estate and multifamily real estate. You know, the idea that you could buy a deal and that it would pay you forever, right? You know, your tenants would pay you. And that is what became much more intriguing to me at the time. So really what I ended up doing was going all in on trying to buy small multifamily properties. So 2 to 4 unit deals. Mm-hmm. And to abbreviate from that first one over the next handful of years, the next really 4 years up until 2020, right around pre-COVID, it was just me hustling and finding discounted off-market deals, doing a lot of direct to seller, like direct mail, cold calling, emailing, texting, all of that fun stuff, finding deals at discounted purchase prices, financing them with private debt, and just organically growing a portfolio. Got to about 50, 60 units in terms of real estate that I personally owned, and kind of hit a point where I was like, all right, well, what comes next? I don't think I'm going to just continue buying these types of properties forever.
Yeah.
And this is right when syndication started to become a really popularized topic online. And this is right when people started talking about how you can raise capital from limited partners or passive investors to fund your deals. So I said, well, that seems like an interesting avenue to go down. I clearly have a track record. At that time, I had done dozens and dozens of deals. I bought and sold hundreds of units at that point, active portfolio being 60, 70 units around that time. And I said, okay, I think I can go out there and raise some money. We can do bigger deals. We can do more deals. Maybe we expand. We go into a different market outside of where I was just doing deals, which I forgot to mention. I live in Boston, grew up in New Hampshire. So while I was living in Boston, I'm buying real estate about an hour north of Boston up in New Hampshire. And that's really what ended up sending me down the road that I'm on now, which is building out a platform where we raised retail capital from accredited investors. And we go out there and we buy small to mid-sized multifamily. And basically I do what I did before, just at a higher volume and a slightly larger scale. So we specialize in buying 20 to 80 unit properties, kind of small to mid-sized multifamily properties. We raise capital from investors to fund those deals, which are usually anywhere from $2.5 to $8 million in size. And along the way, we've done some other stuff. Started a podcast that I've been doing for 4 years now. Been into that for a very long time. Started a property management company as well. So we vertically integrated all of our management. And we also do third-party management in New Hampshire with that business. And, have bought over 500 units since being in the game. Currently, the portfolio is around 300 or so. And our management company manages almost 600 units because we do some third-party as well. And moving forward, I don't have, massive plans of buying thousands upon thousands of units a year. Our business in terms of the short term is we want to keep doing what we've been doing. We've done, over 50 deals in New Hampshire that are 3 to 20 units 3 to 80 units in size, vast majority being that 3 to kind of 20 unit range. And we know that really well. We do direct to seller really well. We buy great deals. We'll keep raising money. We'll buy 150, couple hundred units a year. And that's really the plan for the next couple. And maybe we'll see what happens at that point. But that's the high level story, man. Hopefully that wasn't too long winded.
No, not at all. And honestly, you make it sound a lot easier than it really is, because anyone who's listening to this right now, probably thinking, oh, I could do that too. And yeah, you can. Also, it's a lot of work. So you spent a long time developing a track record. And I'm curious, how crucial do you think that step is or was? Meaning, do you think anyone could leapfrog that step and go directly to syndicating deals and raising investor capital?
I mean, you certainly could, right? I certainly could have made that leap sooner. I had the knowledge, the competence, the ability to execute on the deals earlier in terms of I could have raised money earlier to capitalize what we were doing and to fund what we were doing. The reason I didn't was I personally it took me so long to feel comfortable raising money. Some people are extremely comfortable with that, right? Some people have no problem asking people for money. They have no problem managing money. That just wasn't me. And the only reason I did it was out of pure necessity to continue growing the business. Otherwise, I probably wouldn't have, right? I think if I had lower aspirations of growth, I would have just continued down the path. I think part of the reason that the reason I've never been able to hold a job is I don't like having a boss, right? And investors are fundamentally your boss. You have to answer to them. So it took me a while to get comfortable from an emotional standpoint, I guess, or a comfort standpoint, but I had the ability to do it sooner than later. As it relates to whether people can shortcut that path, you certainly can, but I don't think that people should. We're coming off of 2 years of evidence here as it relates to people who went to seminars, coaching programs, conferences. Yeah. Maybe they bought a duplex. Maybe they had never done a deal, whatever. They left with the confidence seemingly to go and buy a 50, 100 unit asset and to raise money to do so. And a lot of those people are in trouble right now because they didn't have the required experience, especially on the operational side and on the underwriting side, to understand if they were buying a good deal and to operate that deal post-close, right? I had gotten those reps and I had been very comfortable with that. So I think you can, but I am also someone that genuinely believes that you shouldn't just get into the business and jump into a larger deal. I just don't think anybody should do that, frankly, because the risks are far too high. You want to make bets early that you could financially withstand some hardship, right? And you're gonna make a ton of mistakes on your first deal, whether you're buying a 4 unit or a 40 unit or whatever size. You're going to make mistakes. It makes sense to make mistakes with your own money on a smaller deal, whether it's a little bit less painful. And additionally, on top of that, something that I am really passionate about is when you're getting into the business, the easiest way to get into the business is just to buy something. And it's much easier to shortcut your path to gaining momentum and actually getting into the game by just buying a property, whatever size it might be, a duplex, a 5 unit, a 6 unit, right? I think a lot of investors, I speak with a lot of guys who are younger, who are trying to get in the game, or you're even folks that aren't necessarily younger, but they haven't been in real estate. And they hear online that you got to go jump right into the big deals because that's where you have the economies of scale and you should, skip single family, skip small deals. But all that does is oftentimes delay the amount of time, or delay the time between wanting to get into real estate and when you actually get that deal done. Because as a new investor, frankly, this is pretty black and white. you're just not going to be able to compete on larger deals. Like you're not going to be able to do that, right? Real estate is a game of competition. You can collaborate, and it is a collaborative business, but fundamentally there are a pool of investors in every market chasing a finite number of deals. It's going to be extremely hard to be competitive, to gain momentum, to do deals, to know what you're doing, to make any money if you don't at least get a couple under your belt. So I think that, in summary, because of being long-winded, the roadmap is probably take a deal down, gradually grow to the next size, gradually grow to the next size. So if you do a duplex, maybe the next one is 6, maybe the next one's, 20, and then now you're starting to get somewhere. But you got to climb the ladder, in my opinion, right? And I think that is 100% true if you're even thinking about bringing in other people's money. You should only be bringing in other people's money when you've executed on what you're going to do with your own money. That's something I firmly believe personally.
You mentioned, people going to coachings or seminars, and then they walk out, all rah-rah. Oh, I can, do the big deals and everything. I think the missing step there, and just to piggyback off what you just said, is going to a seminar is like, getting the, 10,000 foot view of what it really means to like do a deal. So if you're gonna go straight into like the big stuff, you don't do it alone, right? Like you gotta go, like you have to like either build your knowledge base or latch onto someone that already has the knowledge base and find a way to bring value to that situation, right? And then, because otherwise you're right. Like you're gonna learn the hard way, and it's usually not a fun way to learn,
No, I mean, and we in our business, we've partnered with a lot of investors that are earlier in their journey that bid off a little more they can chew from a deal size. We closed a deal last year. It was 40 units. It was a portfolio. It was about a $4.5 million deal. And the individual that found it was just a younger guy who had still done a couple of deals. He had a duplex. He had like a 3 and maybe a 6 or something like that. And he's just sending out direct mail, trying to find direct to seller deals. And he mailed a woman who owned a 6-unit property, and she wanted to sell her whole portfolio, right? All her entire portfolio of real estate she bought over the last 20 years. So it was a 40-unit deal, relatively decent size, over $4 million. And he just, we had a relationship, and he just took it to us and said, let's collaborate on this, right? This is rinse and repeat for you. You guys have done plenty of these deals. You got the PM company, et cetera, et cetera. Let me ride shotgun. I'll take a slice of it. And that is, conversely to, I'm just going to go and try and raise a bunch of money to do it. Not to say that people don't figure it out and there aren't a lot of happy endings there.
Yeah.
But it's just, there's more variance. There's more risk, there's more reputational risk as well if you're raising money and you're putting your reputation on the line. And in that respect, he minimizes that risk by bringing it to us. We partner on it. And now he's well equipped to go do that on the next one, right? Without me or without somebody else.
Yeah, 100%. It's a great way to build a resume, and you're learning at the same time. Flipping over a little bit, Axel, because you touched on it. Building this portfolio of properties. Generally, what's the strategy there? Like, is it like mostly value add? Are you just like looking at stuff and like, hey, are you just like buying and holding? Like, what's the general? And of course, there's obviously like nuances and variances in the strategy, but like, are you generally value add? Like, what are you doing typically? Like, what's your main strategy?
100% value add deals. Like I said, small to mid-size multifamily, which we focus on because it's a very inefficient segment of the marketplace. I mentioned it a couple of times, like really a core foundational component of our business is going direct to seller. 90% plus of what we do is direct to seller. And we have success going direct to seller in that range because it's not an entirely dominated product type as it relates to brokers doing all those deals. So we go there, we find a seller who's maybe owned a long time. There's some, poor management. They've let rents lag. There's some deferred maintenance. So we come in, we secure a discounted price because we're competing with less buyers, implement the value adds. Typically we'll refi, right? That's usually the goal going in, is to refinance. But we're also very open to being transactional. I'm not someone who's like, I just absolutely must hold everything forever. I think there are times where it makes sense to sell, specifically if a property is like kind of on the edge of maybe where you want to operate a portfolio. Maybe there's some deferred maintenance coming up and you're like, I'm kind of down to let the next guy take care of that. I'll cash out. We'll get this, we'll roll these funds into something else.
Yep.
I also very strongly believe in the velocity of money, right? You earn the vast majority of your returns as a value-add investor. Really the day that you close, that's the most important step in the process. If you buy below market, if you buy at the right price, you lock in a big chunk of your returns at closing. You create, the next significant percentage through the implementation of the business plan. And then when you're done, you're at the whim of what the market does, right? You can operate well and you can maybe operate better than the competition and eke out returns that exceed what the market gives you. But you're at the whims or at the market's whim from a rent growth standpoint, from a cap rate compression or expansion standpoint.
Yep.
But it's no longer really in your control to the level that the earlier part of the process was. So when we get to that point, we're very open to selling and rolling those funds into the next deal. But there are some deals where it's like, mint property, you invested a ton of money in construction and it's right in an area that you're willing to operate for a long time. And those are the ones that we elect to hold. So a little bit of both.
Yeah. And honestly, typically that's what I see in the multifamily space. There's usually no meat on the bone, right? Unless you're doing something to add value, which kind of leads me to the question. It's something I've been asking a few of the guests that have been on recently. Yeah, there's this, I would say maybe growing sentiment that the multifamily space is a little saturated at this point. What would you say to someone that either feels that way or claims to have evidence to support that claim?
I think it's all relative, right? Saturated is a word that will mean different things to different people, I think. It feels saturated if you're newer to the game and you're trying to evaluate what road you'd like to go down and you're listening to people buy self-storage or mobile home parks or Airbnbs or multifamily. And in a vacuum, speaking broadly, self-storage has less investors in that space than multifamily. That's an undisputable fact, right? There are more people buying multifamily properties than mobile home parks or storage or retail or whatever.
Yeah.
But there's also less of those assets as well. So you have a smaller number of people, but they're also pursuing a smaller number of deals. So, again, it's all relative. So I think what I would tell somebody in that respect is, yes, multifamily is probably objectively a little bit more competitive than other asset classes within real estate. But I also view that as a positive because that makes it easier to raise capital. That means the market is much more liquid from a debt standpoint. There's multifamily investors take it for granted how much debt is available to finance what we're trying to do here. We got the agencies, we got local banks, we got local credit unions, we got debt funds, we got all these different lenders. Whereas if you're buying a self-storage property, you don't have your version of Fannie Mae or Freddie Mac like the agencies. That doesn't exist for those types of product type, right? So you're going to banks and you're borrowing higher interest rate debt. And when you go to sell, the market is less liquid at that point as well. There's fewer buyers. So yeah, multifamily is a little bit more competitive, but that also means that it's much more transactional in terms of you can get in and out of deals. You can recap deals a lot more easily. It also means that if you spend a lot of time learning this game, you're going to be compensated in an outsized capacity, right? It's much more worth it, in my opinion, to excel at in the multifamily space and to become a top, whatever it is, 1% investor in your marketplace because of the abundance of opportunity, right? If you're in a market like, I don't know, I'm just throw a city out there like Dallas, and you buy every single self-storage property in the market, okay, your net worth is X, you own this amount of storage, what have you. If you buy every single 20 to 80 unit multifamily asset, your net worth is X and your portfolio is orders of magnitude larger than the individual that bought all the storage, right? Again, a very simplified example, but the market opportunity is much wider as a result,
right? Because
the overall value of the multifamily real estate in any given town or city across America is wider. So when I think about it, I'm like, if I'm going to be in this game for 50 years, which is what I told myself when I got into this, because being in it for 10, 20, 30 is where that hockey stick starts to shoot straight up from a growth standpoint. I want to understand this asset class. I want to be in a market where the market opportunity is incredibly wide and is going to reward me for seeing it through for a multi-decade period of time. So I think there's some counters to that, but fundamentally it is true. And the other piece of it that I forgot to mention too is like buying multifamily and I'll use Dallas again, multifamily in Dallas or Tampa, Florida, or one of these extremely competitive markets is an entirely different competitive landscape than buying multifamily in New Hampshire. Like those are two different planets in terms of who I'm competing with, even if it's the same deal in terms of like a unit count standpoint. So I think it's really market dependent as well, as it relates to, how saturated a market might be.
Yeah. And as we were talking too, I remembered at the beginning, you were talking a lot about, off markets and how you guys, find a lot of your deals off market. I would have to imagine that, the saturation that people feel a lot of times, right, comes from the fact that the deals that see the light of day in terms of like, getting, put on LoopNet or CoStar or the MLS or whatever, like those probably feel a lot more competitive and saturated and stuff. But when you're able to find deals off market, it's like a totally different ballgame, right? Like suddenly everything becomes a lot less saturated, right? So
yep.
I really want to spend some time there because I think that that's where, the listeners are going to get some value here. Let's walk through some of the tactics that you use to find off-market opportunities. Like let's dive deep a little bit. So you said cold calls, you said, text, emails, all that stuff. And by the way, like, just disclaimer is, this is for entertainment and we're not telling you to do anything illegal. But anyways, right.
Exactly. So from a tactics standpoint, here's what I would do if I was starting from scratch and I wanted to go develop a pipeline of off-market deals going direct to seller. So starting from zero, I haven't done anything quite yet. First thing I want to do is I'm going to go buy a data list, right? In the geographical areas that I want to own property and then I want to buy property in. I'm going to filter it based on the unit count range of the types of properties I want to pursue. And then I'm going to filter out properties that have sold recently, right? Anything that's been in the last 3 years. There are some exceptions to that. If you're in the Sun Belt, you might want to target people that bought in 2021 because those people are getting hosed most likely if they use the wrong debt. I'll put that aside. In general, most of the time, you want owners to have some length of ownership so they got some equity. I'm going to go ahead and take that list. I want to get the mailing address, which will be a part of buying that data list, because I'm going to want to send some direct mail to these folks. And then I want to find the true owners that are actually the owners of these assets, right? So you might have to go to like an open corporates. You may have to, to work through a process to kind of crack the LLCs to get the owners of those LLCs. Google search, probably not our best time for me to get into that, but that's going to be the next step. And the reason you want that is so you can take all of those individuals and so you can go skip trace your lists and get email addresses and phone numbers. All kinds of services that you can use to skip trace. Lead Sherpa is one that we've used most recently and have for a while. Now I got my data list. I got the owners. I got the property addresses. I got the mailing address, emails, phone numbers. Now what I'm going to do is I'm going to start mailing this list with direct mail, right? Direct mail doesn't have to say anything crazy. Hey, I'm so-and-so. I'd love to make you an offer at your property located here. Include some language about your experience, right? If you don't have any experience, you should, leverage maybe a partners or something like that. We own a portfolio consisting of X amount of doors, or we own this building in town, or this or that or the other, right?
Yep.
Give them a reason to feel like you're credible. Talk about the value of working with you. Flexible closing timeline. You won't have to pay any broker commissions. We're not going to overly bug your residents, which is a huge thing to the smaller mom and pop owners that self-manage. They don't like the idea of having to bug their tenants.
Yeah.
Anything that you think might speak in that market, no financing contingency, etc. How they get in contact with you, there you go, right? Not rocket science. It's more about doing it than what it is. Get that mail out, send that mail out, give it a couple weeks, go through and either call or text the list. Do a 1-to-1 here so that you're compliant, right? In terms of the disclaimer. You don't want to do a mass SMS outbound blast because that's typically not going to be compliant. So go through 1-to-1 call, 1-to-1 text. You can just do this off your cell phone, right? We don't need any fancy tech to do this. If you have a massive data list, maybe you want to go and hop into a CRM here, get a little bit more structured, but in general, this is how you should start. Hey, so-and-so, following up on a mail piece that I sent you, as a reminder, my name is this. I'd like to make you an offer on your property here. Would love to chat with you if you'd be interested in learning more about what we could, potentially pay. On the phone, over text. If you have an email list, if you have good emails, start sending emails as well. If you touch people in 3 different ways, you're ahead of 90% of what everybody else is doing. A lot of people send mail, a lot of people call, they do it infrequently, they don't do it consistently, and they don't do a combination of a lot of these things. So if you do a lot of these, you're going to have conversations with sellers. Like people think, it's funny, people just assume, a lot of people that own multifamily, like, I would never pick up a call and talk to a guy like this. Like, and they just put themselves in the shoes of who they think they're prospecting to. Well, that's probably because you're a little bit more sophisticated. You listen to podcasts, you read you're listening to, or you're reading blog, you're listening to podcasts, you're reading books. You have a better sense of the game, right? But that doesn't mean that the 70-year-old guy that bought this property 15 years ago isn't going to be like, you know what? I'm good. This guy sent me a mail or he called me at the right time. I think I'm just going to talk to him. And next thing you know, that guy's signing a PNS. Like, that happens all the time. We buy hundreds of units every year doing this. And that's really the fundamentals. Anything above that is you're tweaking the last 10, 15% to really optimize, but that's 80% of it. And then it's just doing it consistently for a very extended period of time. Multifamily, long sales cycle, right? You're going to have a conversation with Joe who's got 123 Main Street that's like, I think my son might want to take it over. I don't really know. And then, you're going to chat with him again in 3 months. He's like, maybe we're going to renovate a couple of the units. Speak with him again in 6, and maybe. Next thing you know, a year in, he's going to be like, oh, my son doesn't want it. We renovated some of the units. We have to evict a couple of people. I don't really want to go through that. Here's, I'll sell it. So it's maintaining consistent activity over an extended period of time, staying patient, committing to the process, consistently following up, and just doing that, getting the reps in over and over and over again. So high level, that's really that's what we do, right? It's nothing crazy, but like we do the simple stuff, the easy stuff. We just do it a lot and over a long period of time.
A couple things that stood out there to me that I want to highlight for the listeners is multi-channel. So we're not just relying on one channel, right? Like we're not just relying on mail. We're not just relying on calls. We're touching them in a variety of different ways. Because as you just said, right? Like some people respond to different, if I get an email, probably not responding to it. If I get a voicemail or a phone call, definitely not responding to it. But if I get a text, it's probably that I'm responding to it. But if I've seen their name on the email or whatever, anyways, but I guess what I'm trying to say here is that multi-touch and multi-channel marketing is really the only way to market now. And secondly is the consistency aspect of it. You're right. Like most people do it 1 or 2 times and then they just move on to the next thing. And it's like, dude, it's the consistency is where you find all the results, right? It's where you find all the results.
100%. And again, another little mindset shift, right? We're not doing this to find a deal. We're doing this to build a robust pipeline of opportunities, right? And it's subtle, but it's different. One of those requires consistent activity over a long period of time to develop the top of your funnel. The other one, if your goal is to get a deal, well, then your actions are oftentimes not justified because you're not getting that deal after that first round of mail, or after you kind of call through your list of 100 properties, you make 100 cold calls, and you're like, I didn't get something. But the idea should be we're trying to build our pipeline. So you have some conversations, that's good. We're building our pipeline, right? You still have to make a ton of offers before you get a deal. The other, again, subtle mindset shift. Doing one deal is going to 10, 20,000x your marketing spend and your time investment, because when you're doing this specific to multifamily, the deals are quite large, right? Relative to what you're spending. Let's say you have a list of 1,000 properties. You send mail to that list every quarter, every 3 months, 4 times a year. So you spend $1,000, a $1 mail piece 4 times a year, spend $4,000 a year. Let's say you do that for 5 years before you get a deal, right? Which is like, that would be insane. You would have to be dropping the ball in every capacity. You would just have to not be picking up the phone. You know what I mean? In order to not get a deal done, or you'd have to, again, there would be some other issue there. But you spend 20 grand on mail, but you buy that $1 million 10-unit property for $825, $850K, not even a massive discount, 15% below market, right? Maybe a little bit more. Okay, well now you've literally almost 10x your investment from a marketing spend standpoint, right? Just doing one deal over that entire period of time. So understanding that once a deal crosses the finish line, you're good for the next 5 years. Like that's what we don't even track our marketing spend as it relates to the deals we do, because like we do a couple a year and I'm like, oh, I'm good for another decade of direct mail marketing. And investing into this. And the beauty in multifamily too is like, even if you don't do a deal along the way, the just the overall brand awareness, the rising tide lifts all boat dynamic that you will achieve by putting your name, brand, company logo, message in front of 1,000 multifamily owners in your market, even if they're not selling to you, is massive, right? We've met a lot of passive investors doing this. Like a lot of people receive our mail and they're like, I'm not looking to sell, but like put me on your list. And we've had people come in and convert us into passive investors. We've gotten referrals to service providers just by other people that we chat with on the phone. They're like, hey, I'm not looking to sell, but like, we strike up a quality relationship. It's not adversarial. Say, hey, you should speak with this mortgage broker. You should speak with this GC, this contractor.
Yeah.
So it's, even if we're not doing deals, there's a value in being top of mind in the marketplace that comes when you go direct to seller that you don't achieve unless you're doing that. That's a sidetrack, but I feel compelled to mention it.
Yeah, no, it makes perfect sense. And I would agree with everything that you just said. We briefly touched on all of the debt products that are available in the multifamily space, but I want to kind of spend a little bit more time there because of the current interest rate environment that we're in right now. I think that, that's something that a lot of investors are having a tough time grappling with. And of course, for those who have loans that are maturing or have matured, that's a whole different conversation. But looking forward into 2024, what are you seeing in the debt markets right now, and where do you expect it to go? And what are you doing internally to kind of like prepare? And it sounds like you guys are still in full acquisition mode. So like, it's like, this isn't phasing you. So would love to just kind of hear your thoughts on like what we can expect in the next 12 months, or what you're expecting to see in the next 12 months, and what you're doing to hedge.
Yeah. I mean, it's tricky in that we can only make decisions with the information we have at any given point in time, right? And that's what we always think, right? If we're making good decisions relative to current market values today as it relates to what we're paying for properties, which is like, that's where we spend 80% of our time, right? We realize if we get that part right as it relates to our purchase price today comparatively to the market value post-closing, which I define as what could we list this property for and sell it for the day after we close. If we're buying at a spread, it makes everything downstream a lot easier. Operations, refinancing in the future, dealing with any challenges that come up. So that's where we spend a lot of time. I'm getting extremely picky as it relates to the types of deals that we go under contract on. Like we're under contract right now on 47 units between a couple of different deals, and they're all direct to seller. We, average discount to current market value, 15 to 20% is reflected by as-is appraisals. And it's like, all right, well, if interest rates start to go up and cap rates start to expand and they follow interest rates up a little bit and the market continues to soften, okay, well, we have some spread here. We have some room to play with as it relates to not finding ourselves in a compromised position from a deal structure, capital structure standpoint. So in terms of from a debt standpoint, we buy pretty much everything with local banks, local credit unions. Great part about doing real estate in New England or just buying real estate in New England is there's an incredibly high number of like long-standing, healthy local banks and credit unions. Yeah. So we just have such an abundance of debt sources there. We do a lot of 75% LTC. We buy stuff nowadays with a rate around 7, fixed for 5, 30-year AM, some interest only, minimal prepay. So we have flexibility, once we're done with our business plan. And that's what we do right now. As it relates to where rates are going, I have no idea. I don't think anybody knows. Anyone who says they knows is lying. Nobody knows, yeah. Right? Jerome Powell doesn't know. So nobody knows. So it's like, we're accounting for the fact that if rates go up, can we refi at a slightly higher rate? We do our underwriting to make sure that is a scenario that we can withstand. If we have to sell at a cap rate that's significantly higher than current market cap rate, I define that as 20 basis points in growth throughout the first few years. A lot of where we buy in New Hampshire right now is kind of a 6.5, 6.75 cap rate market. We'll typically underwrite, a refi value in a couple of years at like a 7.25. Terminal with 20 to 25% basis points in growth throughout the whole period in 4 or 5 years of over 1% higher than where we're going in. I'm okay with that underwriting. Some people might think that's aggressive. Some people might think that's overly conservative, and they're gonna underwrite a smaller amount of cap rate expansion or a lesser amount. I think that's okay for what we're doing because of the fact that we're buying day one at compelling pricing, and I feel really confident with the deals we do because we're not competing with other buyers. Like a lot of people are saying, we're buying it at a great price. Well, you competed with 30 other buyers. I don't know if you did, right? The market found its price, and you were you won. Like, you're the buyer. We're not doing that, and it's because we're direct to seller. We're chasing these smaller deals. So I want to remove the need to have to project anything on the interest rate side as much as I can, and that's typically how we go about doing it.
That makes a lot. I mean, and by the way, like, to each their own when it comes to underwriting. But it sounds like you guys are hedging both from a exit value standpoint. So you're stress testing exit values plus adjustments in rate, during the hold period. So there's some hedges happening on both ends. It's something that just popped in my head as you were going through all that too. I'm sure that there are some people who are listening right now who are like, why would anyone sell to Axel for like 15 to 20% under market value? Like, walk me through, just walk us through why someone would do that.
Yeah, no, it's a great question. And every time we take a deal out to our investor base, I get a version of that question. Why is he selling it for that? Like, why are you so special that they're selling it to you for a price that's less than what the market would pay?
Yeah.
Well, there's all kinds. Distress comes in multiple different forms, right? And again, we're talking about 20 to 80, but really our sweet spot's 20 to 50 unit deals. And I think we need to look at this through that lens. We're not buying 100 plus unit, $10 million plus deals. That's not what we're buying. And there's far less distress at any given time in those types of transactions than where we're playing. And again, we mail 75% of the properties that exist in our marketplace 3 to 4 times a year. Like, we're always in people's ear, right? We've earned the right to be first for a lot of these sales. So again, all of that being said, there's a lot of effort and volume that go into doing this. But again, back to distress, all kinds of distress. One of them, partnership distress. You have 2 partners, they own the property together. They bought this 20 unit deal in 1998. One of them wants to sell, the other one doesn't. They have a disagreement. They just decide to sell, right? And they like the idea of a clean, simple transaction. And we're just happen to be there at the right time. There's a subset of sellers that are just completely allergic to paying brokers. The older the seller is, the more likely it is they don't want to pay brokers. A lot of people just think they can do it themselves. And they can do it themselves, but they're going to do it worse than the knowledgeable broker, but they don't believe that. So they come out and they say, all right, well, I want $2 million, and maybe it's a deal where a broker would have taken it out at 2.1, 2.15. But they kind of know that, but they don't want to pay the broker. So they're okay with, paying a little bit less. And we work a deal. Next thing you know, we're under at 1.875 and it's a 2.15 property. We got some margin there, right? We're buying at a level of a discount. A lot of conversations start with sellers because they don't like the idea of paying a broker. And next thing you know, they're down the road with us. They've invested a lot of time with us and we get it under contract. Yeah. Management, tenant issues. You got a 15, 20 unit building. They got to evict a few at the same time. Their PM placed a bunch of the wrong tenants. They want to fire their PM. They don't know who they're going to replace their PM with. F it, I'd rather sell. Yeah. Deferred maintenance. A lot of buyers aren't interested in buying deals with deferred maintenance. So we'll come in and we'll clean a lot of stuff up, and we're okay, getting into a little bit of a hairier deal and a hairier situation. Sellers sometimes know that if they have a quality buyer on the phone like us, right? And again, we have tons of credibility in this marketplace because we bought hundreds of units. So it's like hundreds of units to a guy that owns a 25 unit property, a 30 or 40 unit property is a very meaningful portfolio size as it relates to that type of deal. And we're never dealing with any turbulence from like a can you close standpoint. It's like, we can close. Yeah. We offer competitive terms. We come in with big deposits. We make it a no-brainer, right? So it's a lot of different stuff. It's a sheer volume of all of this. And a lot of deals, it's multiple things. We got some management distress. We got some partnership distress. We came in where we offered a 14-day due diligence with a $50,000 deposit on a $2 million deal. We tell the seller when DD expires, you can take the deposit out of the title company and you can put it in your personal checking account. Like we'll release the deposit to you. Some people are like, yes, I love that idea. You know what I mean? And motivates them to compromise on price. So there's a lot of different reasons, but people do things for different reasons. And the last thing I want to mention here, people think that the wealthier somebody is, the more sophisticated they are, the harder it is to secure a great deal. Not the case at all. The wealthier somebody is, the more open they are for things to be easy, for transactions to be seamless, for them to have to do less work. Like we did a deal with an owner of a 45 unit building last year that we paid $6.5 million for it, appraised at $8 million while we were under contract. And it was just a guy who was extremely wealthy. He was worth probably, I don't know, $30, $40, $50 million. older guy. He had built a bunch of property throughout the years. We just hit him with a mailer and he goes, dude, I just don't feel like having a broker and doing the whole, like, you know, I don't want to have to walk 1 million buyers to the property and bug all the tenants. Yeah, you guys can just buy it. That's my number. Because he doesn't care. Like it's easy. Some people are down to trade their time for dollars, trade some dollars for convenience. Yep. That's an extreme example of that, but that is something that happens all the time. Oh yeah, if you give me my number, I'm cool. Even though their market value number might be a little bit higher. So there's all kinds of different reasons. I mean, I could go for a while, but yeah, some people just have a hard time conceptualizing that. But what I would tell everybody is thousands upon thousands of units are transacting every day through this medium and throughout the country. Like the proof is in the pudding. The proof is in the data. Like there's all kinds of investors doing these deals. So there must be some truth to it, you know? That's how I like to think about it.
Yeah. And, you know, as you were describing all that, like what really hit home was this idea of almost like, you know, building a relationship with the seller. Right. And it sounds like a lot of times now in that example that you gave at the end where it's like, hey, just give me a price kind of thing. But it sounds like a lot of times, you know, you're essentially like removing a lot of the sales barriers. And what's funny is that like people who are allergic to brokers, like I love that phrase, by the way. So the sellers who are allergic to brokers, it's interesting because in my experience, having worked on the brokerage side for so long, it's true that statistically for sale by owners sell for like, I don't know how many percentage points lower than more
than the difference in commission. Oh, for sure.
Yeah. Way more than 6%. Way more. Yeah. Way more. Yeah. So there is some truth there, to all of that. And, what I would just kind of end that with is you just got to do the work to find the deals, right? To work directly with the sellers. Cause like, that's the hardest part is like getting in front of them, finding the people to get in front of and building that relationship. But Axel just gave you the play-by-play. You know, he just gave you the full breakdown. You
got to trust that it works, right? And the reality is that you don't have to do that many deals for it to all work.
Right.
Buying real estate below market value the day one is the easiest thing you can do to accelerate your returns, compound your money more efficiently, and reduce your downside risk. Like the one decision that you can make that makes all of the other decisions a lot easier. When you pay market, everything else needs to go according to plan. When you buy below market, stuff can fall apart behind the scenes, you know, to an extent, not completely, and you're okay, right? So the stakes are really high in terms of getting that right, which is why we spend so much time on it fundamentally.
Switching gears a little bit, when it comes to your, I'm assuming they're 506C raise.
Yeah, we do. I mean, 75% of what we do, 80% of the deals that we do is 506C. We've done some Bs, but vast majority 506C. Yep.
Are you syndicating these deals individually, or did you raise a fund? Like what's the deal there?
Yeah, we typically do deal by deal. I've never really wanted to go the fund route just because of the increased legal complexity, the increased administrative requirements behind the scenes to track. Really, it's all the accounting, you know, capital coming in at a different time, tracking different preferred returns, hurdles, all that stuff. So we still very much, we'll go out there, you know, we try to limit our raises to deals where we're at least raising like at least over $1.25 million so that the legal costs don't really start to eat into the deal. So on a deal that's usually $2.5 million in size, it's kind of like the bare minimum from a deal size standpoint that we'll go out and syndicate with our investors. We'd like to keep that above $3 million. The smaller stuff outside of that, I still, you know, buy real estate personally, right? I'm still, you know, my North Star in this business is to own a portfolio of real estate that I have no investors in, and you know, I call the Aligned Real Estate Partners business where we're working with investors like my day job, right?
Yeah.
Until I have enough capital to no longer work with investors. So I still personally buy a lot of real estate. I have a couple of, you know, friends and business partners and colleagues that like, we'll go 50-50 on stuff. But from a syndication standpoint, usually it's when we get to that $3 million in size. So the legal costs aren't totally, you know, they're taking a big chunk out of the deal itself.
Aside from having that initial track record of success before you started raising funds, how did you initially and to this day engage your investors, and how did you build that trust with them?
Through the podcast, really. I mean, that's the short answer. And then the Instagram account. I got very active on Instagram and started this podcast 4 years ago. This is late 2019, early 2020, with no monetization strategy. There was no end game. It was just like, I started the podcast because I wanted to chat with people that were more experienced with me. And I was like, it'll be easy to get them to talk to me if I hit record and put it somewhere. And then the Instagram was just kind of like a personal outlet of like, oh, here's what I'm doing in the business. It was more fun. And little did I know that just doing that for a very long time and building some level of an audience on there and just telling my story over a long period of time would just build out the base of individuals that knew me, liked me and trusted me, right? You want to be known, liked, and trusted by people in your network. I think we've all heard that phrase. So that was really it. Because for me, like my personal network from like a personal friend standpoint, I started raising money in my mid 20s. Like, the college buddies didn't have enough money to throw at real estate deals quite yet. Yeah. And I didn't have the professional network from like, a lot of people transition out of a W-2 and into the real estate world and they have their W-2 network, never had a W-2. So for me, that was really the only road to go down. So I was raising capital from people that listen to the podcast and follow me on Instagram. That's really how it got started.
That's awesome, man. And I think that just speaks to the power of social media and, how quickly you can amass a following that works for you in many ways. I think it's funny because like people, you just like to go off on a slight tangent. People think that all these YouTubers make money from like ad revenue. And it's like, dude, like doesn't pay any bills.
The sprinkles on the Sunday.
Yeah. It's how you bring that audience and create funnels, using that audience to feed whatever other, enterprise you have going on, whether it's, clothing or merch, some of these guys have merch or for someone like you or me, we're raising capital and if you can find ways to leverage social media to kind of feed your businesses, that's kind of where the magic happens. We're coming up here on time, Axel, but I did have a couple last minute questions here for you. And we didn't get to this earlier in the show, and I really wish that we had talked about this earlier, but I'm curious, in this epic run that you've had, what's the biggest challenge that you've run into and how have you overcome it?
We've had some deals, or I should say I have, because it's the only deals that I've ever gone or lost money on or that I've gone sideways have been deals that have my own money in. And they've been deals where I know I'm kind of taking a riskier bet, getting into a new market, into a new area. So, not every deal is a home run. Like I did a deal in Indianapolis. It was like a new market for us. I wanted to go out and get into that market and just didn't know the market that well. I thought I knew it well, didn't in hindsight. Wrong location, wrong business plan for the property, paid the wrong price. Guess how it turned out? Not that well, right? So there have been lessons from a deal by deal standpoint. So I could go into those, but I'll just speak generally over an overall principle that's developed as a result of doing that, which is if you really want to have success and compound your efforts, right? Everything gets a lot easier when we're in this game for many, many years. But you don't allow time to help you if you're going from market to markets, if you're going from asset class to asset class, if you're going from strategy to strategy, because you just keep resetting the clock, right? If you spend 2 years developing relationships in this city, but then you stop looking for deals and you start looking in this city, well, you're starting over. You're starting from scratch from a relationship development standpoint, from a market knowledge standpoint, from a momentum standpoint, right? So everything becomes a lot easier when you just do the same shit in the same area for a very long period of time. So for me, that was New Hampshire. And it was like, I kept kind of getting pulled away and my focus was getting distracted. We did some deals in Florida as well. Did very well on the Florida deals. But did well in those deals, but I would have done even better if I just went even harder in New Hampshire where everything was working and my efforts were compounding more effectively. So to make a long story short, I think having a very narrow focus and committing to one strategy, one market, one whatever for a long period of time and putting your head down and not picking it up and not getting distracted by the shiny object syndrome is like the big lesson that I've learned. And the byproduct of that as well is that it becomes a lot easier for other people to help you grow, people to bring you deals, people to bring you money, people to bring you referrals to other people that you should talk to, right, to help build your network when there's no ambiguity around what you do. if you're the guy who's buying this asset class over here and this asset class over there, if you're doing Airbnbs, but you're also doing multifamily and you're buying in different markets, there's a lot of ambiguity around what do you actually do? What are you really good at? The market doesn't really know. You haven't really told the market. When I do small to mid-sized multifamily in New Hampshire, like when people think small to mid-sized multifamily in New Hampshire, I would like to think they think of me. And I know that many people do, because we get brought a lot of deals and a lot of investors. Like when I get on the phone with an investor and they have some sense of what they do, and it's a New Hampshire deal, they're like, we just know that you know how to do this, right? Like you don't have to sell us on your ability to execute, because you've just done this over and over and over and over and over again. Capital gets easier, deals get easier, everything gets easier. When you do 5 deals with one partner, the 6th and the 7th deal become like a no-brainer. It's like, it's like a walk in the park. When you work with the same PM for a very long period of time, everything gets easier, everything gets better. You're not starting from scratch. So very long-winded way of saying that a narrow focus helps everything become a lot easier in your business in every single way. And then time is helping you versus working against you, which is like, we want to put ourselves in a position where time is a tailwind for us, versus something we're constantly battling.
Damn, dude. Some deep wisdom right there, Yeah,
it's like, just do the same shit forever and everything's going to work out. That's really what it is when you break it down. Like real estate's not that complicated at the end of the day.
So true, man. I think, I think it's really easy for people to get shining object syndrome in today's day and age, a lot more so than, probably back in like the 70s and 80s, although I can't really draw from like personal experience, having not lived in the 70s. Or even before, because like access to information is so rampant now. And I think that, you've got a million gurus out there that are teaching you their secret sauce. But I think, and like, this is the way and the only way, and they make it seem like you can't make money in real estate unless you do it their way. The truth is that there's a million ways. Looks like, dude, like your story is unique, and it's not unique in many ways, right? But it's also very unique in some ways. And I think that what that should tell everyone is that there's way more than 1 or 2 or 3 ways to kind of get to where you want to go. And it's almost like that those goosebump books where you're kind of going from, pick your own adventure kind of thing. But I think you're right. Like having that one strategy, that narrow focus and staying committed for years and years and years and years, seems to be a trait that most successful people, it seems to be the thing that most successful people end up doing is they stick to one thing. Well, in traditional gold mine fashion, Axel, want you to, that was so good. I feel like that's the gold nugget, but I want you to dig deep here. All right. And leave the audience with one final gold nugget.
All right, let's think here. So again, high level principled take, right? That you can kind of disseminate or interpret how you'd like to. Real estate is a sales and a marketing business. It's not a real estate business. Real estate's sales and marketing. It's how good you are at becoming known in your marketplace, how good you are at staying top of mind, how good you are at developing relationships, how good you are at follow-up, et cetera, et cetera. If you want to get better at real estate, you should stop reading real estate books and you should start reading sales and marketing books. Like that's going to be the easiest way for you to grow faster versus reading financial analysis books or, how to operate real estate extremely well. It matters, right? But you can develop those fundamentals in a weekend, oftentimes for like what we're buying here. We're just trying to buy at a good price, right? That's what we're trying to do. There's 95% of the marketplace can underwrite extremely well. 5% of the marketplace can consistently generate deal flow and it can consistently raise capital. Those are the 2 highest value skills you can have. So that'll be the gold nugget here. Go buy sales and marketing books if you want to get better at real estate. And listen and consume that type of content just as much as you consume anything related to real estate.
I could not agree more. That is, you should rewind that. Rewind that, listen to that again, because if I can just add this one thing, Axel, is almost every single guest that I've had on this podcast has a sales or marketing background. Very few have like a financial background. I mean, there's exceptions to the rule, right? But almost all of them have a sales and or a marketing background, or they developed sales and marketing skills that allowed them to get to where they are right now. And that's what's leapfrog them into a different stratosphere of success in the real estate game. So, hey, Axel, thanks so much for your time, man. That was straight fire, brother. Appreciate you.
Love it. Appreciate the invite, man.
Yeah, absolutely.